Stagflation. That word has not appeared in a Federal Reserve official communication since 1982. It appeared this morning. Not in a speech, not in congressional testimony, in a published research note from the Federal Reserve Bank of San Francisco, one of the 12 regional Fed banks, staffed by the economists who feed analysis directly into the policy process, that used the phrase stagflationary pressure to describe the current confluence of rising energy costs, decelerating consumer spending, and an interest rate environment the Fed cannot maneuver without making one problem worse to address the other. The note was published at 7:14 a.m. The market opened at 9:30. In the 96 minutes between those two events, institutional trading desks read every word of it. The Dow opened down 412 points before the first retail investor had finished their coffee. Stagflation is not a market problem. It is a governing problem. It is the specific economic condition that ended the Carter presidency, produced the most painful Federal Reserve tightening cycle in American history, and took a decade to fully resolve. It arrives when inflation and economic stagnation occur simultaneously, when prices are rising and growth is slowing at the same time, which is the worst possible combination because the policy tools that address one condition make the other worse. Cut rates to stimulate growth, inflation accelerates. Raise rates to fight inflation, growth contracts further. The Fed has no clean move, and the Federal Reserve Bank of San Francisco just said out loud in a published document that this is the environment the Iran war is building toward. Not building into, building toward. The difference between those two phrases is approximately 4 to 6 weeks of continued straight closure and crude above $87. That window is open right now. In the next few minutes, I am going to show you exactly what stagflation means for every American household that is not a textbook. The specific mechanisms by which rising prices and slowing growth arrive simultaneously at your kitchen table, your mortgage statement, your employer's payroll calculation, and your retirement account's recovery timeline. I am going to walk you through confirmed data from the Bureau of Labor Statistics, the Atlanta Fed's GDP Now tracker, and the J.P. Morgan Global Economic Outlook published Thursday. 3 independent institutional sources reaching the same conclusion from 3 different analytical directions. Because when 3 separate methodologies converge on the same warning, it is not a coincidence. And I am going to tell you why the economic world you are living in today is measurably more dangerous than any press briefing has acknowledged. Because stagflation does not announce itself. It arrives in the data before it arrives in the headlines. The data arrived this morning. Imagine you are a ship's captain. You are navigating through a narrow channel. On your left, a reef. On your right, a sandbar. The reef is inflation. The sandbar is recession. In normal conditions, you have enough water under the keel to steer between them. You adjust left, you adjust right, you use the tools you have. Now imagine someone upstream, without telling you, without asking whether you had enough water, diverted a significant portion of the channel's flow. The water level dropped. The reef and the sandbar are now closer to the surface simultaneously. You cannot steer left without hitting one. You cannot steer right without hitting the other. And the person who diverted the flow is on the radio telling you the channel conditions are fine. Hold that thought. Because that is the exact position the Federal Reserve is in this morning. And the 12 people who sit on the Federal Open Market Committee are the captain, and the channel got narrower on the day the Strait of Hormuz closed. Drop your answer in the comments right now. Is the stagflation warning from the San Francisco Fed a legitimate early signal of a structural economic shift? Or is this the kind of institutional alarm that gets walked back once the conflict resolves and the energy premium deflates? I want your honest read before we go further. Let us rewind the clock. Because stagflation does not materialize from a single event. It builds from a sequence of compounding conditions that individually appear manageable and collectively become a trap. The sequence in this case began before the Iran strikes, in an economy that had been running above target inflation for longer than the Fed's models predicted it would, in a labor market that was tight enough to keep wage growth elevated, in an energy sector that was already running at the structural limits of its capacity. The pre-conflict economy was not fragile, but it was not robust in the specific ways that matter for absorbing an energy shock of this magnitude. It had no spare refining capacity buffer. It had no strategic petroleum reserve at the level it was designed to hold. The SPR, which was drawn down aggressively in 2022 to manage the post-Ukraine energy price spike, had been partially but not fully replenished. It stood at approximately 68% of its designed capacity when the Iran strikes began. 68% of a designed emergency buffer is not an emergency buffer. It is a partial emergency buffer with a known depletion timeline that every energy economist in Washington had been tracking and flagging for 18 months before the first bomb fell. The entire path to stagflation was built on one compounding assumption that preceded the conflict and survived it: that the American economy's inflation management was complete and durable before this additional shock was applied. It was not complete. Core inflation, the measure that strips out food and energy precisely because those are volatile, was running at 3.4% in the most recent BLS report. The Fed's target is 2%. The gap between 3.4 and 2 is not a rounding error. It is a policy problem that the Fed had not yet solved when a $35 crude premium from a strait closure was loaded on top of it. You do not apply an energy shock to an economy that has not yet finished resolving its previous inflation problem and expect the combination to be manageable. The San Francisco Fed's note is the institutional acknowledgement that the combination is not manageable. In writing, this morning, receipt number 1, the Atlanta Fed's GDP Now tracker, which is the most real-time publicly available estimate of current quarter GDP growth and which updated its model Thursday morning with the energy price data from Wednesday's session. According to the Atlanta Fed's Thursday morning GDP Now estimate, publicly available on the Atlanta Fed website, updated with actual data, not forecast assumptions, current quarter GDP growth has been revised to 1.1% annualized. Stop right there. 1.1% annualized GDP growth is not a recession. A recession requires 2 consecutive quarters of negative growth. But 1.1% annualized is within one external shock of negative. It is the growth rate of an economy operating with no margin for additional disruption. And it is the growth rate being recorded simultaneously with a crude premium that is not yet fully passed through to consumer price indices, meaning the inflation reading the BLS will publish in approximately 6 weeks has not yet captured the full energy price impact that is currently running in the futures markets. The GDP is slowing. The inflation reading is lagging the actual price environment by 6 weeks. When the lagged inflation data catches up with the actual price environment, both numbers will be visible simultaneously. 1.1% growth, above 4% energy-driven inflation. Those two numbers appearing in the same BLS and BEA release is the statistical definition of stagflation arriving in the data. The San Francisco Fed published its note this morning because those numbers are 6 weeks away, and the institutional economists who track the leading indicators can already see them coming. The punchline? The Atlanta Fed's GDP Now tracker is updated daily with real data. It is public. It is free. It has been tracking the deceleration in real time for 3 weeks. It has not appeared in a single White House press briefing. Receipt number 2, the consumer spending collapse signal. And this is the one that should make your blood boil. JP Morgan's Global Economic Outlook, published Thursday, included a section on American consumer spending that used transaction data from JP Morgan's own payment processing network, one of the largest real-time consumer spending datasets in the world, to show that discretionary consumer spending in the United States has declined in each of the last 3 weeks, consecutively. Not a 1-week dip that could be statistical noise. 3 consecutive weeks of declining discretionary spending, tracked against actual transaction data, beginning the week the Strait of Hormuz closed. Here is the part that should make your blood boil. The administration has been citing consumer confidence survey data, meaning what people say they plan to do, as evidence that the American consumer is resilient. JP Morgan is citing transaction data, what people are actually doing with their money in real time. Survey data and transaction data are telling opposite stories right now. The government told you the consumer was confident. Then JP Morgan's payment network showed that the confident consumer is spending less on discretionary items for 3 consecutive weeks, and the gap between what they say and what they do is widening. That is not a consumer confidence problem. That is a consumer spending problem. And consumer spending is 70% of American GDP. The 1.1% GDP now reading and the 3 consecutive weeks of discretionary spending decline are not two separate data points. They are the same story told twice by two independent measurement systems. The story is, the American consumer felt the strait closure before the pump price fully reflected it, because they felt it in the futures-driven food prices, in the utility bill projections, in the freight surcharge notifications that showed up in their Amazon deliveries 2 weeks before the $5 gas arrives at the pump. If this channel is giving you the economic architecture of this crisis in a way that you cannot find assembled from any single other source, you are already ahead of the moment when these numbers become impossible for official communications to obscure. What is still coming in this video is the section that connects the stagflation warning directly to your mortgage, your employer's payroll, and the specific retirement account mathematics that change permanently when stagflation is the operating environment. Hit subscribe right now. The BLS inflation report that will capture the first full month of energy pass-through is approximately 5 weeks away. When it lands, every number in this video will be confirmed in a government document. You need to be here when that happens. Now look at what the architects of this economic environment are saying publicly about the stagflation warning. Because the contrast between the institutional signal and the official response has now reached a level that experienced economists are finding difficult to characterize professionally. The White House chief economic advisor was asked directly on Thursday whether the administration was concerned about stagflation risk. His response, and this is a direct quote, "We don't see that. The American economy is fundamentally sound, and the labor market remains strong." He said that on the morning the San Francisco Fed published a note using the phrase stagflationary pressure. He said it as the Atlanta Fed's GDP now was tracking 1.1% annualized growth. He said it as JP Morgan's payment network was logging the third consecutive week of declining discretionary spending. And his analysis, delivered to the American public on a morning when 3 independent institutional data sources were converging on the same warning from 3 different directions, is, "We don't see that." A Republican senator on the Senate Banking Committee, the committee with direct oversight responsibility for Federal Reserve policy and its interaction with fiscal decisions, was asked whether Congress should hold emergency hearings on the stagflation risk. His response was, "The Fed is independent and will handle monetary policy appropriately." The Fed is independent. The Fed whose independence this administration has previously and publicly questioned. The Fed that is now navigating a channel that got narrower because of a conflict the Senate Banking Committee was not asked to authorize. These are not serious people providing serious economic stewardship of the world's largest economy during a documented convergence of inflationary and recessionary pressures. These are officials constructing a distance between themselves and the consequences of decisions they made. A distance that will evaporate when the BLS inflation report lands in 5 weeks and the GDP now reading is still at 1.1. Here is the part that should keep every American household focused on what these numbers actually mean at the level where they live. Because stagflation is an abstraction until it isn't. Until it is your mortgage, your employer, your retirement account's recovery math, your grocery bill compounding on top of your gas bill compounding on top of your utility bill in the same month. The mortgage mechanism is the one that hits the 45 to 70 demographic this channel speaks to most directly. And it is the mechanism that most financial coverage of the stagflation warning is not explaining clearly. In a normal inflationary environment, the Fed raises rates. Raising rates increases mortgage costs for new buyers and for anyone with a variable rate product, but it controls inflation over time and eventually allows rates to come back down. In a stagflationary environment, the Fed cannot raise rates without accelerating the growth deceleration that is already running. 1.1% annualized GDP growth is not an economy that can absorb a rate increase designed to kill inflation. But the Fed also cannot cut rates to support growth when energy-driven inflation is running above 4% and heading higher as the crude premium passes through. The Fed is frozen. Frozen means rates stay elevated longer than they would in a clean inflationary environment. Elevated rates for longer means the mortgage market, both new purchase and refinance, stays constrained for longer. If you own a home and were planning to refinance when rates came down, that timeline just extended. If you own a home and are considering selling and buying a replacement property, The rate environment you will finance the replacement with just became more expensive for a longer period than any pre-conflict forecast was projecting. If you have a variable rate home equity line of credit, the reset timeline that was pointing toward relief is now pointing away from it. The stagflation trap does not raise your rate. It holds it elevated at a point that was already painful and removes the visible pathway to relief. If you are employed at a company with significant energy cost exposure, manufacturing, distribution, agriculture, food processing, transportation, construction, your employer's cost structure is absorbing three simultaneous pressures: higher energy input costs, higher freight costs from the diesel pass-through, and a consumer spending environment that is weakening in real time, which limits the ability to pass those cost increases forward into prices without losing volume. The margin compression that results from those three simultaneous pressures is not an abstract corporate finance problem. It is the calculation that determines whether your employer adds headcount, holds headcount, or reduces headcount in the next 2 quarters. The J.P. Morgan spending data showing 3 consecutive weeks of declining discretionary spending is not a signal that consumers are suffering abstractly. It is the demand-side input into your employer's revenue projection. When that projection is revised downward simultaneously with a cost structure revision upward, the variable in the equation that gets adjusted first is labor. Not executive compensation, not capital investment, labor. Hours before headcount, headcount before facilities. But the sequence starts with hours, and the sequence starts when the margin math stops working. If you hold a fixed income in retirement, a pension, an annuity, a bond portfolio, any instrument that pays a defined amount on a defined schedule, stagflation is specifically and historically the worst economic environment for your purchasing power. Stagflation erodes the real value of fixed payments faster than either pure inflation or pure recession alone, because it combines price increases with the suppressed growth that limits any compensating income gains. The retiree on a fixed pension whose purchasing power is being eroded by energy pass-through inflation, while the growth environment that would normally produce cost of living adjustment pressure is simultaneously decelerating, that person is inside the stagflation trap in the most direct and personal way. The Social Security cost of living adjustment is calculated against CPI. CPI is a lagging indicator. The adjustment lags the actual price environment by approximately 12 to 18 months. The energy pass-through inflation that is building right now will appear in the COLA calculation in the cycle that follows, not the next adjustment, the one after. The fixed income retiree absorbs the inflation now and receives the adjustment later. That gap is not a bureaucratic inconvenience. It is a real reduction in purchasing power for the population that can least afford to absorb it and has the least ability to compensate through additional income. If you are a small business owner in any sector that touches consumer discretionary spending, restaurants, retail, entertainment, personal services, home improvement, travel, J.P. Morgan's 3 consecutive weeks of declining discretionary spending data is not background news. It is your sales trend. Consumer discretionary spending declines before the headline recession numbers confirm it, because households adjust their spending behavior before they adjust their employment status. The sequence is: spend less on discretionary first, draw down savings next, reduce essential consumption last. The J.P. Morgan data shows the first step of that sequence is already running. Your sales data for the next 60 days will tell you whether it is a temporary adjustment or the beginning of a sustained pattern. The stagflation environment, rising costs, weakening demand, a Fed that cannot cut, is the specific combination that makes a temporary adjustment more likely to become sustained, because the normal recovery mechanism is the Fed providing monetary stimulus when growth weakens. The Fed cannot provide that stimulus cleanly right now. The monetary release valve is blocked. The administration did not create stagflation risk to compress your mortgage relief timeline, to threaten your employer's margin structure, to erode your fixed income purchasing power, or to turn J.P. Morgan's discretionary spending decline into the opening movement of a consumer-driven contraction. It created stagflation risk because it applied a military shock to an economy that had not finished resolving its previous inflation problem, in an energy infrastructure environment that had no surge capacity buffer, with an SPR at 68% of designed capacity, without a cost estimate, without a congressional authorization, without an exit condition, and without the acknowledgement that the channel between the inflation reef and the recession sandbar was already narrow before anyone diverted the flow. The stagflation risk is the arithmetic of those compounding absences. The San Francisco Fed named it this morning. The Atlanta Fed is tracking it daily. JP Morgan is measuring it in real transaction data. And the White House chief economic advisor said, "We don't see that." Here is the hard truth. Stagflation is not a surprise when it arrives. It is a surprise to the people who refuse to see it coming, who looked at a 3.4% core inflation rate and a 1.1% growth trajectory and a closed straight and an SPR at 68% and said the fundamentals are sound. The fundamentals of the American economy are genuinely substantial. American productive capacity, American innovation, American labor market depth. These are real and durable. But fundamentals are not the same as current conditions. And the current conditions are 1.1% growth, energy-driven inflation on a 6-week lag to the data, a frozen Fed, a consumer spending 3 consecutive weeks of discretionary decline, and a diplomatic back-channel process running without a public timeline in Qatar and Oman and Switzerland. The fundamentals did not make this. The decisions made it. And the San Francisco Fed was polite enough to use the word pressure instead of the word trap. The trap is what it is. The administration didn't walk America into stagflation risk to set Iran back 50 years. It walked America into stagflation risk because it never modeled what walking in cost. The cost is in the data. It has been in the data for 3 weeks. It was named this morning. Where does this go from here? I see 3 paths. The first I would call the narrow escape. The Qatar back channel produces a framework agreement within 15 days. The strait reopens. Crude retreats from 87 toward the low 70s. The energy pass-through inflation that is building in the 6-week lag pipeline is partially offset by a faster-than-expected crude reversal. The GDP Now tracker stabilizes above 1.5% as consumer spending recovers from the energy cost shock. The BLS inflation report in 5 weeks captures a partial pass-through rather than a full one. The Fed avoids having to choose between the reef and the sandbar because the channel widens slightly before the keel scrapes. The stagflation pressure does not become stagflation reality. But even in this best case, the permanent damage is structural and documented. The San Francisco Fed's note is in the institutional record. The Atlanta Fed's 1.1% reading is in the data. JP Morgan's 3-week spending decline is in the transaction history. Every future risk model for every future Gulf conflict scenario now includes a documented precedent for how quickly an American economy operating without inflation headroom and without refinery surge capacity can approach stagflationary conditions when a strait closure exceeds 3 weeks. The narrow escape does not erase the demonstration. It just means the demonstration did not finish the job this time. The second path is what macroeconomists are privately calling the policy paralysis spiral. The diplomatic process takes longer than 15 days. The crude premium holds above $85. The 6-week lag inflation data arrives in the BLS report, showing above 4% energy-driven CPI simultaneously with a GDP Now reading still below 1.5%. The Fed faces the choice in public: raise rates into a weakening economy or hold rates in an above-target inflation environment, with the whole world watching. Either choice produces a negative outcome. Hold. The dollar's purchasing power continues to erode, and institutional confidence in American monetary discipline is questioned in global fixed-income markets. Raise. The 1.1% growth economy tips into negative territory, and the recession that was being avoided becomes the recession that was created by the policy response to the conflict. The policy paralysis spiral is the scenario where the conflict's economic damage compounds not through the direct price mechanism, but through the second-order policy response that the price mechanism forces. Countries that hold dollar-denominated reserves, and there are approximately $65 trillion of dollar-denominated assets held globally, are watching the Fed's policy paralysis with calculation, not panic. They are not moving now, but they are updating their models for how much of their reserve portfolio they want denominated in a currency whose managing institution is visibly constrained by the fiscal and military decisions of a single executive administration. That model update, running in central banks from Tokyo to Frankfurt to Riyadh, is slow and it is quiet, and it does not produce a headline. But it produces a structural shift that compounds over years. And it started this morning, when the San Francisco Fed used the phrase stagflationary pressure in a published document. The third path is the one nobody wants to say out loud. The BLS report lands in 5 weeks, showing above 4% CPI. The GDP Now tracker is at or below 1%. The Fed raises rates to address inflation, because its institutional mandate and its global credibility require it to respond to a documented above-target inflation reading, regardless of the growth context. The rate increase tips the 1% growth economy into 2 consecutive quarters of contraction. A recession confirmed in the middle of a military engagement with an undisclosed cost, an unauthorized legal framework, a frozen monetary policy tool, an SPR below 70%, and a strait that may or may not have reopened by the time the GDP numbers are confirmed. You would normally say no administration would allow the economic conditions to compound to this sequence without an aggressive diplomatic push to close the strait and remove the energy premium before the lagged inflation data arrives. But the War Powers notification was never filed. The cost estimate was never submitted. The chief economic advisor said, "We don't see that," on the morning 3 independent institutions published data showing exactly that. Normal left the building a long time ago, and there are no more guardrails. Here is what I know for certain. The stagflation warning published this morning by the San Francisco Fed is not the beginning of the story. It is the institutional acknowledgement, belated and carefully worded and deliberately described as pressure rather than reality, that the story has been running in the data for 3 weeks and can no longer be described as market volatility or short-term disruption or buying opportunity without the description itself becoming a credibility problem for the institution making it. The Fed's regional research staff does not publish notes using the phrase stagflationary pressure as a casual observation. It publishes them when the leading indicators have converged to a point where not publishing would be a greater institutional risk than publishing. That convergence happened this morning. Even if the strait opens tomorrow, even if crude falls to 75, even if a framework agreement is announced and the administration calls it the greatest diplomatic achievement since the end of the Cold War, the San Francisco Fed's note is in the record. The Atlanta Fed's 1.1% reading is in the data. JP Morgan's transaction data is in the institutional files. The path to this moment was built on decisions that were documented before they were made, and made anyway. The stagflation risk is the receipt, and it was printed this morning. The Fed is not looking at the next rally. It is looking at the reef and the sandbar and the channel that got narrower on the day the strait closed. Right now, the navigation problem that was created in a 40-minute meeting without a cost estimate or an exit condition or a congressional authorization is being worked in the most consequential financial institution in the world by people who were not in that meeting and were not asked and were not told, and are now responsible for steering between consequences they did not create. That is where the American economy is this morning. And the word for the environment they are navigating appeared in a published document at 7:14 a.m. It has not appeared in that context since 1982. It appeared today. I want to leave you with 2 questions. The first, when the stagflation the San Francisco Fed named this morning arrives fully in the data, when the BLS report and the GDP numbers appear in the same release cycle, and the word pressure becomes the word reality, what accountability exists for the decision makers who said, "We don't see that" on the morning the institutional data said otherwise, and who is supposed to enforce it? The second question is the one that every American household within 10 years of retirement, every small business owner watching discretionary spending decline for a 3rd consecutive week, every fixed income retiree whose purchasing power is being eroded before the COLA adjustment catches up, every worker whose employer is running the margin math right now. That question is this: when it arrives at your kitchen table, at your mortgage statement, at your employer's payroll calculation, at your retirement account's recovery timeline, will the people who built the conditions for it, who called it sound fundamentals, who said Iran was set back 50 years while the San Francisco Fed was drafting a stagflation warning, will they still say it was worth it? Drop your answers in the comments. I read every single one. Subscribe, because the BLS inflation report in 5 weeks is the moment this warning becomes a confirmed data event. And you need to be here when the number lands. This story is not slowing down. Do not look away.